Welcome to the daily briefing from interest.co.nz. I'm David Chaston. Today we check the producer price indexes. We also look at the related capital goods price index, update interest rate changes over the past few days, and we'll wrap up with what the other media are reporting. The upward trend in both producer input costs and producer output prices resumed in the June quarter, according to data released by Statistics New Zealand today. Fortunately, output prices rose slightly faster than input costs. As we've seen in other surveys, construction prices were at the upper end of the price rises, with dairying also gaining well. Poor returns from non-dairy farming also featured, as did good forestry gains. On the cost side, those in construction faced higher increases than their prices, but electricity generators saw their costs decline 11% year on year, while only passed on 3% reduction in their prices. On the farm, expenses rose slightly faster than the rest of the business community. We'll take a look at the capital goods component after this short break. Prices of capital goods, those goods involved in new investment by business, rose at their slowest rate in 3 years in the June quarter. A two-track pattern is evident in the data released by Statistics New Zealand. The investment that involves construction and therefore has less imported components got more costly at a higher rate than investment that involved imported goods. This is consistent with the high and rising currency that was around during that quarter. Construction and building costs rose about 5%, whereas transport equipment and production equipment either did not rise or fell during the same period. For example, the cost of building houses, putting up farm buildings or doing irrigation and land drainage all rose fast, between 6 and 11%. But the cost of computers, machine tools and medical equipment, for example, were all stable or fell. This business data reinforces the tradables, non-tradables distinction in prices that we saw in consumer area and shows how vulnerable we are in our costs to changes in the exchange rate. In the past few weeks, we've seen a very noticeable flight to safety in the investment markets, and the safest investment is government bonds. We're also seeing a more realistic approach to offer rates by non-bank institutions. We've long noted the very poor premiums offered by these companies over Best Bank, but this last week saw two of the largest, Merrick and South Canterbury Finance, raise their offers by quite a bit. Still not enough in our opinion, but in the right direction. Their moves will also strongly pressure other non-bank offerers to raise rates, and soon. However, benchmark government bond yields have been going the other way, down, and that downwards adjustment has been quite rapid, as the chart shows. Banks have traditionally keyed their offers at about the government bond level, although in 2007 they have opened up a small premium. The fall in government bond yields recently will no doubt see future bank offers fall, and we've seen the start of this by both RaboPlus and Kiwibank, and reductions in 3 to 5 year rates by other banks. The diverging tracks between bond, bank and non-bank offers means a growing premium is developing for risk. And finally today, a quick wrap-up of some other recent news. Dutch banking giant Rabobank is set to reap the benefits of investor flight from finance companies, with its first debt issue to small Kiwi investors set to comfortably exceed the $400 million target. Profitable sleepy Southern Cross Building Society was heading for charitable status until a masterful coup by Auckland businessmen. Now it has been reborn as a predator, building stakes in some South Island building societies. You can get more news and stay up with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.